Good afternoon, everyone, and thank you for joining us for the 2024 Executive Briefing Mid-Year Review. Kicking things off, we have a pre-recorded session with Pat Albero and Dan Agaro, partners with Performance Brokerage Service. They're going to provide a brief update on M&A activity in the industry. According to Performance Brokerage Services, the current landscape of equipment dealer merger and acquisition activity is still very strong. The organization says there are more buyers than sellers in the current market. And following record sales, dealers are using excess cash to grow despite rising interest rates. Dealership values are still up, and buyers are hungry for strategic acquisitions. I'm going to hand things over to Michaela Faulkner, who is with Pat and Dan.
We're here with Pat Albero and Dan Agaro from Performance Brokerage Services. Performance is the highest volume brokerage firm in the industry, with over 900 transactions closed in the last 30 years. Pat and Dan run the equipment division for Performance, helping dealers buy and sell dealerships across the United States and Canada. So Pat and Dan have over 35 years combined in the equipment industry, working with dealers and OEMs. They're currently working with a number of dealers who are exploring a sale, and their most recent closing was with a Kubota dealership in Denver. Pat and Dan always welcome the opportunity to educate dealers on the buy-sell process and are excited to be on the webinar today. So we're going to get right into the questions. What does the buy-sell machinery market look like right now?
Thank you for that kind introduction, and thank you to everyone on the webinar today. It's an honor to be here. So great question. We're asked this question almost daily by dealers and buyers. We're very happy to say that the market is still strong today. It's still a seller's market, meaning obviously there are more buyers than sellers. The value of the dealerships are still up and holding strong. We're actively receiving calls weekly from dealers looking for acquisitions, including buyers that are looking to diversify their holdings and enter into the farm and ag space.
Yeah, it's interesting. I would say, as Dan had mentioned, that the pace is at record highs with buy sells currently across all manufacturers. So it's an interesting time for dealers to be really looking at this topic. It seems like sometimes Ben's news articles, or a lot of them, are with a dealership that had just recently transacted, which is big news to the local dealers in the markets.
Definitely. So then what you're saying about what the market looks like right now, how does that compare to 6 to 12 months ago?
Yeah, it's a really interesting question, because tides have shifted a little bit within the dealer space specific to farm and ag dealers. 6 to 12 months ago, dealers were still operating on their allocation and experiencing record high profitability. For most dealers, I believe top line revenue may increase in 2024, but for the majority, the net profit is likely to flatten out this year. So a little bit different of temperature there with profitability to total profitability within these dealerships. But as a company, I think it's interesting to note, so Performance Brokerage Services as a whole completed 84 buy-sell transactions in 2023. And similarly, we've closed 49 transactions year to date, and we're on pace to close 58 dealership transactions by the end of June. So if you just compare those two numbers together, we're on pace to have a record year as well across our entire company.
Wow, that's pretty big news for sure. Especially considering that you said the market seemed to be flattening out, even though the transactions don't seem to indicate that right now.
Right.
All right. So as a business owner, how do I determine if I should exit now or wait a few years?
Yeah, it's a really good question. Sometimes a difficult one to answer. There's a lot of factors that play a role in determining when the dealer should consider an exit. It's almost answering a question with a question. Things that we look at would be market conditions, financial performance, future projections, personal goals, and then really more than anything, the potential valuation or value of the business in the market today.
I'll jump in on that one. One of the important things is understanding what you and your family need per year to live the rest of your lives. An exit means the last chance to earn money from this business. So maximizing the value after taxes, after debt, is a true goal in understanding what is important to the seller moving forward.
So then continuing with the premise that I'm the business owner, what does it look like? I've decided to exit. When should I start planning and how long is that process?
That's a great question. I'll go with a quote from the former New York Yankees catcher, Yogi Berra. If you don't know where you're going, you'll end up someplace else. So the answer piggybacking on that is to start planning today. Building a team is going to be crucial. It can be done in advance, certainly when the process is moving, but planning ahead and then executing that plan going forward. Having conversations with a CPA that has M&A experience, preferably in dealership transactions, one who has a true understanding of how to properly allocate capital from an exit to maximize profit, minimize taxes. A mergers and acquisitions experienced attorney, also preferably in dealership transactions. This is an individual that can guide you, or a firm that can guide you both through the letter of intent in the beginning, the long due diligence process. They create the documents, help with negotiation, and the final execution of the asset purchase agreement, or APA, also known as a definitive agreement. The challenge here is finding a good M&A attorney, obviously one that has experience in dealerships, because an attorney can make or break a deal. We've seen it both ways. If a deal falls apart because of an attorney that is not experienced, the one who makes out is the one who's billing by the hour. In contrast, a good dealership attorney that has M&A experience can guide you around the pitfalls, at the end of the day, costing you less money and saving you money over the process. Just a really quick story. We just recently closed a transaction that the original attorney on the deal said they had experience in M&A, but did not. Halfway through, they had to be removed, and the seller brought in an experienced transactional attorney that helped him close the deal in a timely manner. It cost a lot of money. It almost cost the deal. The third person is a good buy-sell advisor. That's going to be somebody that has experience, specializes in dealerships, is a critical member of the team. They not only help manage the buyers and the seller, but they work closely with the CPA and the attorney on both sides to get the deal all the way to closing. As a dealer, you still need to run your business day to day, continue to make money, take care of your customers, manage your employees. Your buy-sell advisor is the one who enables you to do that, all while having a critical piece of maintaining confidentiality throughout the process. And the last person on the team, is certainly not the least, is the wealth planning expert. The sale of business very well may be the largest liquidity event that happens in a dealer's lifetime. Getting to the finish line is only the beginning when it comes to managing the windfall of capital and working to make it last the rest of your life for yourself and your family. A good wealth planning expert who specializes in dealership exit planning is a critical part of the team.
Yeah, and I'll just add on that, Dan. It's interesting. There's a lot of key players that are involved in this, and the dealers have to be considering confidentiality more than anything, right? Exploring the idea or the thought of a sale does not mean that they're selling their businesses, and we really hold that close to our heart, and making sure that we protect that as much as we possibly can. So pulling those people in that Dan had mentioned, we have contacts. We have people that we've worked with over those many transactions. At this stage, we've done over 900 dealership transactions as a company. So certainly something that we can help with on that note. But once you have that team in place, and you know what your dealership could be worth, I think only at that time you can start to frame up the right time to sell your dealership.
Makes sense. And then what would be the next step?
Our firm being a success fee only firm, right? So we don't charge a penny unless a deal takes place. So if you imagine, a lot of the relationships we build in the ag space could be for many years before a dealer chooses to transfer the business internally to a son or daughter or family member, or again, putting all the cards on the table, look at a third-party sale option. We're there to provide complementary products and services and things to the dealers in regards to a buy-sell guide. So we've got a printed guide or a PDF version that will be able to share every single step within the buy-sell process. It's just good for the educational purposes. We always want to offer a free 30-minute consultation to any dealers that's watching this today. Obviously, it's what we do every day. We only sell dealerships, so certainly something we can talk at a high level on. And then lastly is a complimentary opinion of value. And again, that goes back to just making sure you know what the dealership is worth before you take a step forward.
Pat, I'll jump in on that. Talking about confidentiality, all conversations that we have and should be had with anybody that you talk to are held in the strictest of confidence. Our reputation, our clients' businesses, their families, their customers depend on it.
Definitely. I know that's important to so many of our viewers. So with that, if somebody is interested in taking you guys up on that 30-minute free consultation, how do they go about getting in touch?
Yeah, it's a great question. I'm sure in the links of the video here today and the recording, they'll pass along our contact information. But performancebrokerageservices.com will provide all the background on our business and really the depth of the different dealerships we represent within farm and ag, and then many other types of dealerships that our firm works with as well.
Perfect. Thank you, Pat and Dan, for sharing your insights today.
Thank you very much. It was a pleasure.
All right. Thank you to Michaela for getting us started with that. And we are going to move on to our next session now with Mark Johnson from Pinion Global. Mark is a principal with the organization, and he's going to provide an update to his 2024 Equipment Industry Economic Outlook. Thanks for joining us, Mark. I'm going to hand things over to you now.
Very good. And I've got one screen here, so I'll make sure I know what I'm doing here when I share. Oops, which I didn't. Do it again. Kim, could somebody give me a heads up that I'm showing the right thing?
You are showing the right thing.
Very good. I'm sorry for that. I'm usually much better at this, but today I'm traveling a little bit, and I have one screen in front of me instead of two or three like I'm used to. So apologies for that, and then apologies for also Kim gave me about a third as much time as I'm used to doing on one of these. So she has probably a big hook that she'll pull me off stage here in a little bit if I go too long. So anyway, I'm happy to be on this one. The forecasting this back in November was tough enough. Forecasting now may be even tougher. So I put this as a reminder. This is one of my slides back then that I'm pretty sure that economic forecasting was created to make weather forecasting look good, because it's a little bit difficult position right now to look at the economy and say what's next. So I'm going to do my best today, but one of the things I've noticed this year, a couple things, is my dealers are getting their information to me later than ever to finish up their audits, which we're all done with now, but our audits went out later than ever. So we have a later than ever baseline to look at anything, because, just stuff was changing so much during January, February, March that a little late doing that. And then second off is the economic forecasters from the banks that normally do a lot of these kind of presentations are not doing as many of these presentations as they used to, just from the standpoint of it's such a volatile market right now that they're a little bit afraid, I think, to go on record and do some of this stuff. So evidently I'm not fearful to go on record, but I go on record saying you can't hold me too much of it. So anyway, I'm going to update a few numbers. Some of the stuff we talked about back in November was the title of that was there was a lot of stuff going on, that there's rumors and there's stuff going on in the market that's just kind of distractions. We had talk about recession. Didn't happen. Got talks of inflation. Clearly, the talks have been about it going away. It doesn't seem to be going away as fast as we wanted to, and definitely instability. Some of that caused by the fact that we've got an election coming up, and we've got, we got an election coming up. We've got, the interest rate issue coming up. We've got a bunch of tax provisions expiring. None of that has changed. We've got a farm bill that has got a little bit of progress going since November. So that's a little bit good for you guys. It doesn't have everything in it that everybody wants, and it's got some stuff in it that some people don't want. So whether or not that passes in its current form, it's too early for me to even go through any of those details, I believe, on that farm bill, because I think it's a ways off. But some of the stuff we can't go through, just another big thing that has we've been talking about is we got 2030 that we're headed to as ag dealers. So there's a little bit of built up demand that's going to be swelling between now and 2030 with population change. And so just to kind of update that, we were heading towards a $10 or $11 billion person population. We're growing at about 82 million net a day. And that hadn't changed. It hasn't gone up or down. It's still just growing a lot. So we're still kind of on pace for that. So 2030 still looks like we're going to need about 30% more out of our existing crops than we've got now. So whether that's with higher prices, whether that's we got selling more equipment that gets more efficient and gets more yield out of the ground, whatever that is, we've got some work to do, and I think that our farm equipment guys are at the right spot for that. With that said, we've got some stuff going on here that also updates. So if you just look at economic performance between last November and now, things have grown faster than we thought they would. You might remember me saying that typically the fourth year of a president's term, and this would be the fourth year of Biden's term. Before 2000, that was always a decline. It was about a 7 to 8.5% decrease in the GDP and the stock market, and just about every way you looked at the economic performance. But since 2000, it's actually been a 2.5% gain. So people are kind of looking forward to a change or something. If anything else, they're looking forward to an election being over, I think is more what it is. And so we kind of look at the fourth year of a president's term as being a 2.5% gain. Well, you can see everything has grown more than that. S&P is up 11%, NASDAQ's up 11%. The Dow Jones, which is a lot less stocks, is up 5%. The only thing that's not up is corn. And corn is, in November, it was $4.66. If you back up to the February before that, it was closer to $6. Now it's down to $4.36 today. That's a 20% decrease just since November. So that's got most of my ag guys feeling like, I don't know what you're talking about. The economy is doing good, inflation's looking good because corn is terrible, and corn is what drives all of our numbers in an ag equipment dealer. GDP is only up 1.3%. Inflation's still at 3.1, just down a tick from 3.2. And as you might recall from that one, they've kind of redefined how they look at inflation, such that we used to say 3% inflation was the number we would be aiming for. When they take out energy, when they take out food, which is most of what we buy, they say that inflation number ought to be down to 2%. And until we get in between 2 and 3%, they're probably not going to mess with that interest rate right now. So the interest rate and the interest rate that we're worried about on here is the one that the Feds charge to the banks, also known as the AFR rate, and that really hasn't gone down from November to now. The Feds haven't actually pulled any triggers to make that go down. The rates have fluctuated just a little bit, point something percent in there, just based on some confidence factors and things like that. So effectively, that rate is down to 5.12, but no triggers have officially been pulled to pull that rate down. As far as ag performance goes, things have changed a little bit on that. We've got a 2024 cash receipts forecast out anyway, and it doesn't look pretty. Everything that you can see there on the first slide would be from crops, and between 2022, 2023, 2024, every one of them pulls back quite a bit, especially corn. Again, for those of you that are in a market that says, hey, corn isn't my driver, I hate to tell you this, but corn probably is your driver, just because corn, every demand we've seen on the sale of equipment almost parallels the pricing of corn, and so that's why we focus so much of it, even in markets that don't sell a lot of corn. Obviously, the other crops impact our cash flow, and so we show those, but they're all down. And even in cattle, which was our kind of star in 2023, being it had increased over 2022. It's pulled back a little bit now as well in 2024. And so that culminates in the right there. Our government payments are way down. I showed a 2020 through a 2024 graph only because everybody wants to talk about how far down it is from 20 and 2021. I don't think it's fair to look at that because there's so many numbers in 20 and 20 and 2021 that were based on PPP money, ERC money, all the free money that the government was handing out to farmers and to everybody else that impacted this. And so, but if you compare 2022 to 2024, you can see that we have a pretty serious decrease in cash receipts forecasted right now. What that looks like in numbers is right here in the middle. You can see the net cash farm income in 2024 is expected to be $121 billion, down from $160 billion in 2023, and down from $202 billion in 2022. That leads down to total net farm income of down from 185 in 2022 to now in 2024 forecast of 116. So that's 16 to 25% decrease in cash receipts, depending on how you look at it. And that's not a good thing at all. Some of these times we also look at producer sentiment. So I've updated the two here that we look at a lot. Creighton being the kind of the middle of the country forecasting, so big row crop farming. Purdue being everybody, all the crops in the country. We look at a sign of growth as somewhere in the 50 mark for Creighton, as you can see. Since the end of 2023, that has dipped well below 50. Now, I would caution you now, just like I cautioned you back then, sentiment graphs are just that. They're what farmers are feeling, not necessarily what is fact. And farmers are feeling in election years a lot of being unclear about stuff. And so uncertainty basically leads to a little bit of fear and a little bit of decreased expectations of growth. For those of you on the call that are actually farm equipment dealers, which is most of you, you can see I also superimposed in here Creighton actually asks banks and what they call thought leaders, so it's bankers, professors, insurance agents and things like that, people that are heavily involved in the ag space, what they think about the ag dealers as far as their signs of growth. And you can see that was also well above 50, and that tanked just along with everything else. So if you're feeling it, so are the sentiments here. Now, the weird thing is on Purdue, which is the whole country now. So we've got the dairies and the fruit and vegetable farms, as well as the commodity crops. That one looks a little bit better. It's still down considerably, but it's still above 100 for our current conditions, and 100 is their mark of saying growth. So even the current guys are basically saying at 101, they are saying we're barely better than we were a year ago. Now, a year ago, though, was last May, which was already down a little bit. But what they're saying about the current conditions, that one's actually been on the rise. It's 120 right now, saying that we expect next year to be a little bit better than this year, primarily because we believe the Feds when they say we're going to decrease the interest rate. That happens, we're going to be a lot more positive about the future. So what does the Fed think? So I showed you this back in November. This is what stirred a lot of the talk. This Fed said, hey, we're looking for an interest rate down. We're looking for an inflation rate down in the 2 to 3%. And if we get that, we're looking to have interest rates down to 3%. Again, the rate that the Feds charge the banks, so they add on a percent or two there from the banks. So if we're looking at a 3% Fed fund rate, we're looking at somewhere between 4, 5, 6% rate from the banks. That would be a breath of fresh air. That's what they're projecting for 2026. That stirred everybody into thinking, hey, things are going to look a little bit better. They said we're going to do that. Our first one's going to be about May, and then we're going to do it every quarter. We're going to do about a quarter point per quarter until we get down to this rate. Well, May came and went, as you know, and that didn't happen. Part of the reason is because in 2024, you can see that we haven't dipped below 3% on that inflation rate yet. In fact, we've ticked up 3.1 in January to 3.4 in April. We don't have May's numbers yet, but I don't anticipate that that's going to be below 3 either. So that's not good. Now that's a lot better than it was in 23 and 22, but it's still above 3. And until we get under 3, we're probably not going to see an interest rate. That's what the Feds say. What do some of these bankers say? Well, the bankers all liked it early. Now that's kind of a mixed bag. You can see there on the right, there was a survey that Reuters put out for economists, and of the economists, greater than 50% of them said that now, this is an update in April, now we believe September is the earliest we're going to see an interest rate. In March, that number was greater than 67%, thought it was going to be starting in June. So we pushed that back quite a bit. Of those same people that they surveyed, again, greater than 50% though do say we're still going to get 1 to 2 rate cuts in 2024. And of the ones that are saying 1, most of those think that we might get a half point instead of a quarter point come September. So there's a pretty good consensus that we'll still see a 0.5% decrease in that interest rate before year end. With politics involved in a November election, that's probably almost guaranteed that might be our October surprise, but that we probably will get one. And 33% say that there'll be more than 2 cuts. So maybe we still get the 4 that the Fed said we're going to get. You can see I put a few quotes out here as well. Standard Chartered, which is a big bank, they still think that the data is out there that we might get July cut. The next Fed meeting is June 11th and 12th, and after that is July 30th and 31st. They think there still might be a July 30th announcement. So does Citi. They're not as much as they thought. They do think that there's still a decent chance that we'll see a July rate cut, though. Morgan Stanley, though, they've changed their mind. They've moved it out to September. Wells Fargo, who's near and dear to a bunch of your hearts because they do seem to do a lot of dealership financing. They have also said, well, we're looking at September and December, and it won't take much for us to push the September back to November. And then Barclays also says that we're going to be pushing that out. But none of them say we're not going to see anything decrease, so that's good. Hasn't been a whole lot of change other than to what I already showed. Crop prices are still down. We haven't seen any big thoughts of increase. Long-term forecasting isn't much better on corn, so that's not good looking. I also showed this graph back in November. It's also gotten a little bit different this is the deliveries from manufacturers to the dealerships. We started showing a long range look at this from 14 to 23 because we weren't understanding why the numbers were so small. We thought it might have been a supply chain issue. It's not a supply chain issue, as you can see right now. It is we cut it. We saw this coming. We cut it a little bit. You can see in February and March they cut it even more. Almost all the manufacturers have announced pretty big decreases for the remainder of the year in their production levels to help out the used market. So all that combined, our overall look at this right now puts that growth for you guys at just around 2%, and that's if we get an interest rate reduction. That's built in. The general economy beats this thing up a little too bad. Commodity prices aren't much better, and then that sentiment from the farmers we can't ignore. And so all that's got our overall projection down about 2.2% for most of you. So what do you do with that? You can build that into economic data and forecasts. You should. You can't just say that, hey, we grew 20% last year, we grew 20% the year before that, we're going to grow 20% again next year. It's not going to happen. You're going to be maybe somewhere in that 2%. Some of the mainline manufacturers believe that you'll see 10 and 15% decreases. So you should look at a hard look at your forecast and build that into your forecast so that you don't run out of cash. And then, with inventory increasing, you really need to know what your numbers should look like for next year's orders and that kind of thing. So analyze all your costs, all your commitments and contracts. And if you have any questions, you can reach out to us. With that, I'll turn it back over to you, Kim.
All right. Thank you, Mark. So next we are going to just move into our panel discussion portion of this. We're actually going to have Mark hang on with us. Joining us, though, now are Brad Arnold, Vice President of Massey Ferguson North America, and Adam Reed, the Vice President of Sales and Marketing at Versatile. Mark's going to stick around because we're supposed to have a dealer with us on this panel, but he was unable to join us. So Mark's going to pinch hit and do his best to provide some of that dealer perspective on some of our questions. So I guess to start off, can each of you just give us a brief introduction of yourself and your company, and then we can kind of dive into some of our questions. Brad, do you want to get us started with that?
You bet. Can you hear me okay?
Yep, sounds good.
Very good. Yeah, Brad Arnold here from AGCO. As Kim mentioned, I'm the Vice President of Massey Ferguson North America, so I lead our Massey Ferguson business here in North America. Obviously, AGCO operates under two main brands, whole good brands in North America, the Fendt brand, our premium brand, our volume brand, straightforward and accessible and dependable brand of Massey Ferguson, along with our technology brand, which we've just launched, PTx, which includes the precision planting business, as well as PTx Trimble, which is the new joint venture as we acquired the ag business of Trimble. So good to be with you all today.
Great. And then Adam?
Adam Reed. I'm the Vice President of Sales and Marketing for Versatile, based out of Winnipeg, Manitoba, Canada's only tractor manufacturer that's left. And we recently went through a transition right around Christmas time, the new year. We were purchased by a company out of Turkey called ASCO Holdings. So that is currently what we're operating through now.
All right. Mark, any background we didn't touch on in your quick overview that you want to add in?
Well, I guess since I'm representing the dealers today, just so you know, I do. So most of my time is spent out in dealers, talking to them. We quarterly we go out and go through a host of key performance indicators and a management report that we go, and I'm fresh off the road from that. So this week alone, I've been in 4 dealerships, so I do have some background noise in my head from dealers. So hopefully I'll be able to answer questions that come up.
All
So.
right. Thank you. Adam, we will start with you with our first question. Same question for all of you, but how has the first half of 2024 compared to what your expectations were for how the year was going to go?
Well, as I mentioned, we were recently acquired by a new company, so I don't think it's an industry secret that we were owned by a Russian manufacturer prior to December 31st. So that created its own set of challenges for the past couple of years, particularly since the invasion of Ukraine. So not having that hanging over our heads has certainly improved our overall outlook internally, at least, being able to re-energize our supply chain base, which has obviously been a challenge for us for the past couple of years. So I would say that the first half from a production standpoint has actually gone better than we expected. We're putting a lot of our previous supply chain issues in the past, so we're able to have a more consistent level of production. I don't think it's as great as any of us or our dealers would like it to be, but it's certainly improving, and it's a lot better than it was. From an order standpoint, we're still working through a backlog and of retail orders as well as wholesale. So I'd say the first half of the year has gone roughly as we predicted. I think the challenges that we have had are mostly internal, just as we bring the new ownership group up to speed. And then we're still dealing just from a sentiment perspective. Mark talked about farmer sentiment. We're dealing with some sentiment issues on the dealer side, just because we've been an inconsistent supplier for the past couple of years. So we're working to get past that.
Okay. And then Brad, how about for you?
Yeah, I think on the challenging side, as you've heard a couple times already on the call, our sales are coming off record highs from 2023. We see our 2024 North America retail forecast being about 10% lower than 2023. We expect the high horsepower row crop segment to decrease, after several years of strong growth that had much higher levels of net farm income. But on the optimistic side, while the drop in net farm income that Mark just showed us is pretty significant, it's still essentially on average of the last 8 years that he showed in that graph as well. So it does show that farmers are still investing in technology that makes sense. And we're actually seeing some strong market share growth, but in particular on a rural lifestyle business, CUE business too. So from kind of a highs perspective in 2024, we've had a lot of pretty significant expansions that I wouldn't mind talking about. Our PTx acquisition of the Trimble Ag business that I mentioned in the brand topic as I introduced myself. Our focus is really different than most every other OEM in the sense that we're creating a technology umbrella brand of PTx that includes the Trimble portfolio as well as the Precision Planting portfolio that is able to retrofit precision ag technology on any make and model, any vintage of competitive equipment. It's integrated into over 100 different OEMs that we sell to directly, as well as integrating that technology into our own brands. And so this focus on the ability to retrofit, in particular in a tougher market for farmers, to be able to add technology that allows them to get more out of every acre, we really believe is something that levels out, the cyclicality of the ag business for us. So that's been great. We just launched the Fendt Lodge at a grand opening as we kind of establish our brand home here in North America up in Jackson, Minnesota. We just celebrated that last month, the 16,000 square foot brand home where we can bring customers, teach them about the Fendt spirit, do launch events, have some dealer meetings, some dealer trainings and customer trainings, corporate gatherings, those kind of things. So as well as just a bunch of great product launches from our Massey brand as well, including finally getting into the sprayer business on the Massey Ferguson side to give farmers a smaller, lightweight, dependable sprayer in our MF5 R series sprayer. So lots of things to be excited about, even though the market certainly is coming off those highs.
And then Mark, anything that you've gathered in your visits with dealers on how the year's going versus what they may have been anticipating 6 months ago?
Yeah, when we started out the year, we kind of looked at a 6 to 7% growth number still available to most our dealers in 2024. Most of that was going to be from leftover pricing changes versus unit changes, but and the fact that our dealers, frankly, are getting a lot better margins even today than they were prior to 2020 on even on their used. So we kind of raised the bar in 2020 when supply kind of started dwindling, and we've kept that bar up a little bit. Now the margins have tightened a lot, but so what's happened is instead of looking at that 6 to 7% growth, we're looking at 2% at best. So my bigger dealers are probably the ones that are being a little more aggressive. The auctions have started already. What I'm seeing though is dealers are typically taking stuff to online auctions, and they're doing something like every week or every couple weeks or every month. There's some systematic auction processes going online to get some of that used, because that's really the entire issue right now is cash flow is generated by the fact that our inventory has increased a lot. To those dealers that have programs that have pool funds or profit sharing type stuff that could buy some of that interest rate or some of those down, great. To those dealers that didn't have it, not that great. So the dealers, what we're seeing is the dealers in the Midwest, big row crop combines and high horsepower tractors, they're in a lot worse shape than the guys farther out that are dealing with small horsepower stuff. But even small horsepower, if you look back at that graph that I showed earlier, the big change in the supply market hasn't been on the combines and the high horsepower 4-wheel drive stuff. It's been on the smaller ag and the 2-wheel drive stuff. So challenging year. They're addressing it by looking at expenses. They're addressing it by pulling back some cash flow commitments on as far as distributions or ancillary stuff that they might have been looking at, as far as new buildings or airplanes or, depending on the success of the dealership, what we're looking at there, but dealing with it all they can. But frankly, the expense side, the big ones that we're seeing, there's 4 big expenses that are way up over prior year as a percentage of anything anyway, and that's labor. Can't do much about that. We're still looking for good people. There's the one that's surprising would be data processing, which is basically cybersecurity is the issue that's driving that. So dealers spend a ton of money on cybersecurity right now, so much so that it's showing up. And we're seeing 10-12% increases, and that hasn't shown up before. And then vehicle expense and repairs and maintenance. So big increases there. You get past that and you can't deal with much. It's pennies at that point. So the equipment dealers are dealing with it, but it's not as fun a year to be a dealer as it was prior year. But it's not all black and terrible either. So.
Just a quick note to all of our attendees: if you want to submit any questions while we go, there is a Q&A icon at the bottom of your screen. You can submit a question there anytime, and I will work them into the mix for our panel. All right, so that was kind of our look back on the first 6 months of the year. Looking ahead now to the second half of the year, how have your expectations changed from what your original forecast was, and what are you expecting to continue to change as the year goes on? Brad, do you want to start us off on this one?
Yeah, you bet. I want to point back to what I said earlier on farm income. I think it remains at relatively strong levels. We've seen input costs start to stabilize, fuel, fertilizer, seed costs start to stabilize. So again, we expect farmers to continue to be profitable, which again continues, as Mark's saying, to put dealers in a positive light, even though we as OEMs are going to have lower sales ourselves. Retail levels are still going to be stronger as we pull back on dealer inventory. So from an overall dealership perspective, we feel good about the health of our dealerships. And the one concern, obviously, is we get to aged inventory and interest rates being at a high level compared to the last time we were in this declining or contracting environment. That certainly can have a more negative impact on our dealers. Overall, we still continue to be bullish about 2024, as I said, mostly because of our focus on things that are still growth levers for us. The Fendt brand in North America is still relatively new. It's about 6 years old. as we brought the road crop tractors over from Europe. So we continue to close white space with more dealerships, expanded dealerships, a decent amount of M&A activity that's also solidifying our dealer network. So we still feel like we can grow at about 4 to 5% beyond the industry, even in a slightly contracting environment. The precision ag side as well, retrofit. I came from precision planting. In the acquisition, I was a general manager, and so we've always seen really strong growth in years where new whole good purchases start to decline as farmers start to buy solutions that clearly add significant yield potential on small investment basis to retrofit existing equipment. So we really like our strategy. We really like the portfolio that we have to be able to solve those kind of problems for farmers.
Okay, Adam?
Well, we're in a slightly different position in that we are pretty much only in the large ag space. I mean, our smallest tractor is 175 horsepower. So we're in a lot more narrow space when it comes to the broad acre and, of course, the big row crop side of the business as well. As we look forward to the next 6 months, I would say that our projections are still steady. We were hoping that we'd be able to increase production, but we do not have an inventory problem right now. It's probably the lowest part of my list in terms of issues I'm dealing with, largely because we're still working through the backlog of tractors that are on order both for retail and wholesale. So I think the adjustment of expectations has been we were hoping we'd be able to ramp up production faster than we have been, but we're being a little bit more bearish on that. We don't want to overshoot that target and end up with a major inventory problem like we all lived through, I think, about 10 years ago when 14, 15, 16 happened and we were all sitting on inventory. And of course, inventory for the dealers, especially at the interest rates we're at now, would be the kiss of death. So we're being trying to be smarter, as smart as we can anyway. We don't want to overload the dealers, but that's a long way in the future. Right now, we have a lot of dealers that haven't seen a tractor from us in a couple of years in extreme cases. So we're repopulating the earth, and this is going to kind of chew into the next point on early order, but we still have to get a lot more equipment out there into dealer yards, rebuild our exposure. Now, the one thing that we do have going for us that we're excited about is that the dealer network's starting to get a little bit more energized, starting to work through some of the issues of the past. We've got a fairly sizable queue of dealers that had wanted to come on board. Obviously, a couple of years ago, that list would have been longer when no equipment was available. We were an option because they couldn't get anything from anybody. So maybe the company in Canada can get us some stuff, which, we couldn't really help them much either. But we've got a fairly sizable queue of dealers that have expressed interest in coming on. Some have signed up or are in the process of signing up, but we don't have a lot of equipment to spread around. So we're keeping that tap fairly closed for now, but we keep working with those dealers, keep them warm until we actually have equipment available. The working through the next 6 months of production, making sure we can keep that steady, keeping our suppliers on board, and slowly starting to increase production out of the factory here in Winnipeg is a big part of what we're doing. Of course, same thing. We're watching the U.S. election. We're keeping our eye on interest rates and commodity prices. Right now, I mean, this is going to affect the next few months for us specifically, but right now, the weather, particularly in our key market, which is Western Canada, is very have or have not. We've got some places that can't buy water, and we've got other places that are drowning. So there is a fairly sweet spot in the middle there somewhere in Western Manitoba, Saskatchewan, that's going to have some really good looking crops, knock on wood, of course. But yeah, that's affecting our retail forecast, just as everyone's kind of in a wait and see mode from that perspective. But again, we're shipping tractors now that were retailed, say, 6, 8, 12 months ago, and those farmers aren't backing off of that. Of course, everyone expects a price increase for model year 25, so we're still filling a lot of that retail demand as we go.
Okay. And then, Adam, we'll stick with you because you alluded to the next question about early order programs. What's Versatile's expectations for those programs this year?
Well, I think it's been a couple of years, 3 years, I guess, since we've been able to go through a regular early order program process, just because we've been dealing with backlogs and supply chain issues. So I would say that I'm cautiously optimistic, and I think also a bit of a realist about what we can expect going forward. We have some fairly heavy hitters in our dealer network that really have been idling for a while. And I think where we fill a niche, as I mentioned, we're kind of in the larger side of the agriculture space, but where we fill a niche is we tend to be a value player. There tends to be a price gap between a versatile tractor and everybody else. And I wouldn't say some of that is just more the bells and whistles in the cab than anything. I put our engine transmission architecture up against anyone in the industry. But where we shine is in that value space. And like Brad was alluding to, adding technology to the older tractors, our tractors have been designed to basically accept a lot of that technology. So a farmer that wants to add a lot or a little, when they buy a Versatile, they can do that with it. So that's really a space that we fill. And historically, when times have gotten tough and cash receipts have gone down, Versatile tends to excel, or at least be able to maintain or grow our market a little bit, because again, we're offering that value side of the brand. And when times are tight and guys need to replace equipment, they'll sometimes take a look at what color that paint is and decide how much that paint's actually worth. And at some point, $200,000 maybe doesn't make a lot of sense if you can get the same technology and the same performance in a cheaper package. So that's really what we're looking at for next year, for 25, as we expect things to get quite a bit tighter. Again, our forecast is in line, but again, we still have a lot of repopulation of machines to do before I start to worry about having too many inventory out there. And I think the other thing that we did is we lived through, I was here through a really tough time in that 13, 14, 15 timeframe, where we basically took the "if we build it, they will come" approach, and how that impacted our dealers, how it impacted us as a company, having 200-300 unsold four-wheel drive sitting here in Winnipeg. We desperately do not want to relive that again. That was a pretty painful time for everybody, including our dealers. So, you always say you're going to try to be a little bit smarter next time. So we'll see if we actually are smarter in the next 18 months, particularly under the new leadership group. So that's kind of how we're looking for next year.
All right. And Brad, on early orders?
Yeah, for us, we're back kind of in line on our order board with historical, levels. We've had significantly elevated levels of order boards over the last 2 years. We're down to about 4 to 5 months coverage, which is plenty in North America across most of our portfolio. We've got about 6 months plus, just over 6 months of supply at our dealerships. We generally like to play in that 4 to 6 months. So, again, which is why, as an OEM, we're pulling back slightly our production levels, which will be lower than what we think retails will be, so that we can kind of pull it back in line with that 4-month target to still allow us to capture more market share. We think we'll grow probably 4 to 5% market share in North America this year still. That is 4 to 5% off of our base. We're actually seeing, similar to what Adam just talked about, in particular on our Massey Ferguson high horsepower portfolio, being the volume brand, being more of a value than some of our competitors or some of our premium brand on the fence side. We're seeing strong market share gains here early in the year as farmers choose more cheaper, reliable solutions that have great technology, but come at a much lower cost of ownership. So it's good to have such a diverse portfolio, in a time like we have right now.
Right. And then sticking on early orders for a moment, Mark, a question came in for you. What does your crystal ball say about combine early order program levels compared to the last few years? And I'd say everyone can probably chime in on this one, but they called you out specifically, Mark.
Yeah, it's what I hate to say out loud with the manufacturers on the call, what my dealers are saying about combine orders for next year, but it's not good. I mean, they're very concerned. Like I said, we went through a period of time where we had a bunch of cash. All our cash has disappeared because our inventory is tripled, last year. And so, every purchase, including inventory and early orders, are being highly scrutinized at the dealership level. Now, some of that you can't go to zero, for instance, and expect the manufacturer not to respond. I mean, they have to. You agreed to sell their stuff, right? But we are seeing, if we could go to zero on some stuff, I think we probably would. There are some dealers that are sitting on that much inventory right now. Okay, and even they're new. The problem is their used isn't that old either, right? Because we sold a heck of a lot of equipment in 21 and 22, and that stuff is coming back in as used right now. So we've got low hour, high horsepower stuff sitting in our yard that's priced like new, and so that early order thing is something I imagine our dealers are going to lose a lot of sleep on between now and whenever their deadline dates are.
Anything as it relates to combines, Brad or Adam?
Yeah, I think just from my perspective, one of the benefits of being, a lower market share holder in North America, as AGCO is both with the Fendt and the Ideal Combine and the Gleaner Combine on the Massey side, as even in down markets, again, generally we grow market share. So we're estimating much lower industries, obviously, but we feel like our market share levels are actually going to grow this year. In this kind of environment. So
I'm not touching combines with a 10-foot pole, but thanks.
All right.
I mean, we do. I mean, in general, we use the combine market as a barometer for the large four-wheel drive market. Those two tend to be joined at the hip by somewhere between a 6 and 9 month thread. So, obviously we're keeping an eye on it, but specifically what's going to happen, I'm not touching combines with a 10-foot pole.
Yeah, I think honestly what's going to happen with combines is it depends on how good our sales guys are at securing, we're basically going to order what we know we've sold, and so that's going to be dependent on our sales guys being active out in the market at a time that's a little difficult for them to be active out in the market. So.
All right. And then this question came in early on during Pat and Dan's session, but Mark, you might have some insight into it. What financial metrics are being used to value dealerships, and what are those multiples today?
It depends on the buyer. Honestly, there's a host of buyers out there right now, and they're not the same buyers as they were when everything's going good. It's dealers buying dealers. It's merges happening. It's just some speculative stuff going on. What happens in a market like this is that what we're seeing right now is we're seeing dealers buy dealers across that aren't attached on their AOR. There might be in the news you just saw a Missouri dealer buy a New York dealer, for instance, and I think we're going to see stuff like that for a couple of reasons: diversification of both the client base and the AOR. But that buyer is a dealer, so he's going to look at things like EBITDA and balance sheet, and he's going to look at what do you own, what are your hard assets, your inventory. I'm going to pay you what those are worth. Then I am going to look at your EBITDA and how much cash flow you've kind of generated and give you some goodwill on that number. But those multiples range very much dependent on the dealer who's buying it and the dealer who's selling it. And then the other dealer or the other buyer out there right now is some version of an equity guy, whether it's a family office or a private equity fund or some guys that are actually trying to put some deals together that we are going to be a dealership equity fund. And those guys buy on cash flow. So what they want to know is how much return am I going to get on my cash? And they brought their number down. Back in 5 or 6 years ago, they were pretty strict. They said, we're going to come in here, we're going to basically lever up your debt so that you're maxing out your floor plan lines to your manufacturer. You've got the minimum level of equity in your equipment as possible, and that way we can buy you cheaper so that we can get a 30% return on our cash. So we don't have to put much cash in, so we get a big return on our cash. They brought their number back, understanding that interest rates have increased. Dealers are having to pay interest to their manufacturers now. They're not getting that all sold before it hits interest-free expirations. And so those are what those are. So the two things that we're looking at, they haven't changed. The numbers have just come down. The equity guys are looking at a return on cash, which is basically projecting what our future cash flow is going to look like and discounting that back today. Now, interestingly, the fact the interest rates have gone from 1 to 5% on our risk-free rate, that 4% directly correlates to how much return we got to get just to get past the risk-free rate because the risk-free rate is over 5% right now. So where they used to be looking for a 20% type return, they'd have to get a 25% return before they pull that back now, just because they gotta borrow the money at higher. The dealers buying dealers, that's still we're still kind of looking at some EBITDA, but I can't really give you a multiple, and here's why. If I give you a multiple, it depends on how many years they're looking at. 2020 through 2023 were record year piled on top of record year piled on top of record year, and one more record year. So we have 4 years of records in a row. If we look at a 5-year history of EBITDA and try to put a multiple on that, knowing that 2024 isn't going to return anything close to that, then our EBITDAs have to drop, or our EBITDA multiples have to drop from the standpoint of we know we can't regenerate the EBITDAs that we've had the past 4 years. That was at a high. So unfortunately for you guys, I probably can't give you an EBITDA number that means anything. It still really comes back to what's our future projection look like, and what can the guy buying me generate for additional EBITDA on top of his, and that's going to be an individualized discussion, unfortunately, at this point.
All right, thank you. And then next one, I'll let whoever wants to jump in first take this one. How will the outcome of the 2024 U.S. election affect the dealership market?
Go ahead, Mark. I'm an accountant, not an economist. So,
well, actually, I can be agnostic as far as who wins, and because it doesn't. There's two things that no matter who wins, we're going to see something happen on that are both very good for dealers. The first is bonus depreciation. At some point, we won't be having an election anymore, and the sides will pass a tax bill to fix bonus depreciation. Because for those of you who haven't been paying attention, we used to be able to buy a $100,000 piece of equipment, and the farmer could write $100,000 off. In 2023, he could buy a $100,000 piece of equipment and can only write $80,000 off. In 2024, he can buy a $100,000 piece of equipment and can only write $60,000 off. Next year, 40, the year after that, 20, the year after that, 0. So that's the first year write-off. So that is bonus depreciation. That's why it has to be fixed. Both sides of the aisle agree that it needs to be fixed, but neither one of the sides of the aisle want to give the other one credit for passing the bill. So it ain't going to pass until November 6th, and then magically they'll have the votes for it to pass. That will be good for our dealers, and hopefully it'll be retroactive. There's some R&D credits and things like that, same way. Things that we know need to be fixed, everybody agrees need to be fixed, but they're not going to let either side fix it until after the election. So that's good news. That means no matter what happens, that's going to get fixed. The other news is no matter what happens, we know interest rates are going to go down. And interest rates, the combination of interest rates and a better tax deduction mean we're going to sell a lot more equipment once those two barriers are passed. And that barrier very well could be November 6th election. So those are the good things. Then the non-agnostic version, depending on who wins, we're going to see another tax bill down the future that's going to deal with bigger stuff, estate tax reform that's got that's going to sunset also in 2026, and our estate bills go through the roof. And the two sides of the aisle have different fixes for that. So I'll let you guys do your own reading and figure out which side you want to vote for based on that. But there's definitely some huge differences on how estate taxes get fixed. And then on top of that, we've got things like immigration reform. That's going to highly impact our farming clients, which will eventually then impact our farming equipment dealerships. So the election's going to deal with that. For the most part, though, I think November 7th is a bright and shiny day because the presidential election is over. Somebody won, somebody lost. We don't care, because at least we can move forward and worry about and not have to worry about a presidential election again for 4 years.
All right. Anyone else on that? Otherwise, we'll do one more question and then wrap up since we are at about the hour mark. Do you guys think the market will see market share scattered over much more brands, since the market might give the cheaper brands a gateway? So is that going to change the market share picture that we currently are seeing or used to seeing?
Yeah, I'll take a crack at it. I think, being the Massey brand leader for AGCO. We definitely are positive on our ability to grow shares. I mentioned earlier in this kind of market environment. Now the overall industry is coming down, right? So that means on absolute numbers, we'll maintain kind of relatively flat volumes, but on a much different industry. And certainly it will give, I think, shortliners and other value brands opportunities to be competitive and provide spot solutions for farmers. That's really, when times get tough, farmers focus on things that have immediate ROI. And so when we can demonstrate or show them, we can lower their cost of ownership on a tractor, we can provide precision ag technologies that deliver a 3-bushel, 4-bushel improvement because we're better placing inputs to optimize yield or minimize our input costs. Farmers are still going to spend money on that. And so, I think to answer the question generally, how farmers spend money this year certainly will look much different than how farmers spent money in 2023.
Yeah, Versatile doesn't report our sales numbers, so we're not part of the AEM data that gets released. So we quietly chew through our own section of the market. But I think we've, due to our production issues for the past couple of years, in our case specifically, we've got a lot of ground to regain that we've lost. So for us, I mean, obviously we're optimistic that that's going to happen, and we just need to get our dealers back on board, get the machine population back up to where it should be out in the field, and then deal with it from there. But I think if you look back over time, it's like Brad was saying, those that seem to move faster, smarter, better, particularly in down times, there's an opportunity for that market share to shift around. But, obviously there's a couple of major OEMs out there that don't like to see their market share drop. So, we all play the game. I think we're getting back into the time where we just have to be a little bit more faster, flexible, and just be ready to be on the spot where we need to be when we need to be. And that's how dealers are going to get one.
All right. Well, with that, we are at the hour mark, so we are going to wrap things up. Thank you guys all for joining us. Really appreciate you sharing your insights on how the market is looking right now and what your expectations are for the rest of the year. Also wanted to invite everyone who is on today and registered for the mid-year review to join us for the 2025 executive briefing, which will be December 10th and 11th. Up on the screen, there's a promo code for 20% off registration. Just needs to be redeemed by June 28th, and you can visit agequipmentintelligence.com/2025EB to redeem that. Thank you once again to Mark, Brad, and Adam, and to Performance Brokerage Services for joining us for this mid-year review. Hope everyone has a good rest of your day.